Alright folks, how's it going? It's the time for the weekly investment diary. I've added this information to the spreadsheet just to show you each time. It just gives a proper perspective of how well I'm really doing, because obviously these weekly numbers in isolation are kind of meaningless, aren't they? But it's a nice little update each week. But the bigger picture is here. How I'm doing this year so far from the 6th of October, and how I've done since 2017 from the 6th of October that year. It's sort of my disclaimer, just in case people didn't realise that I'm actually quite a bad investor and my track record is not good. It's kind of in lieu of that disclaimer I used to show at the beginning. But as you can see, I'm actually a pretty terrible investor. My portfolio since 2017 has had a total return of 31.43%. Compared to the Life Strategy 100, which is 88, Life Strategy 80 and 60 are 66 and 46 between them. So I've underperformed everything. So yeah, I've underperformed quite badly over the years. But it makes me feel comfortable and I enjoy it. So that's my justification for it. But yeah, anyway, this week I've beaten my benchmarks again. But I'm still behind from the beginning of the year, which was only a couple of months ago. Well, the first thing to say is, if you watched last week's video, I've realised that the numbers in there were completely wrong in this cell here, I had the 29th of October instead of November. So all the numbers I showed last week were completely wrong. So anyway, so let's have a look at last week's numbers, shall we, first? And the major one was, it seems like the JP Morgan US smaller companies was still on a mega bounce last week or the week before. Biotech growth was on a bounce. Oh, Harmony Energy. Right. So the news that came out about Harmony Energy last week actually had a pretty decent effect over the whole week. Last week it only showed like a percentage up for the whole week because I had the wrong information being shown. So yeah, it seemed like it was pretty good. And then Fundsmith, just for the record, will show what Fundsmith Holdings did. So I mentioned the Texas one's doing well, but that was absolutely false. And if we put the real information there, we can see that CrowdStrike did pretty badly, but nothing else was really an outlier. So let's have a look what happened this week then, shall we? Oh, Meta's done really well. Amazon's done really well as well. LVMH having a bit of a comeback from its terrible time it's having recently. Anyway, there's the numbers, not much to say. SCHG's had a bad time this week. Minus 2.59. Yeah, the markets really liked that Harmony Energy news, even though it wasn't really news, it was a delay. So that's a bit confusing. So yeah, another 10% after 6% last week. So I'm actually up 17%, which is pretty damn good for Harmony Energy. But then obviously it all gets offset by the other one, which has done poorly. Anything else to note for this week? Yeah, I'm not sure why SCHD's done so badly this week. Bit of a weird one. Oh yeah, and I noticed this. I can't believe it's finally happened, but NatWest Group is in positive territory. Quite a shocker. I've owned this one since God knows when. And it's never really been in the green since today. Oh, and that does include, I rebalanced from Barclays to NatWest, but when I did that, I actually kept the cost basis from Barclays. So it's not like I've averaged in at a lower cost basis. I've actually fudged the cost basis to keep the cost basis that was at a big loss from Barclays. So it's not like this number is kind of cheating, because it could easily have been cheating, that number, because I bought at a lower level when I put money from Barclays in there. And obviously, yeah, Barclays is lagging behind a bit. But yeah, it's still a terrible investment from when I did it, if you compare it to what other things have done in the time, but it's nice to see that it's in the positive, finally. And there's the dividends for you, 421, so another pretty good week, mainly because BlackRock smaller companies fell in that week, and Pfizer was a nice little one as well, 35 quid from there. So let's go through the transactions next, shall we? So on the first of the month, every month we have the update from Fundsmith, and I just kind of looked through the top 10 list, and in the end he told us that he'd sold Apple, which he only had as a very small position, and my position in it was a little bit higher, but I still followed him because also the other person I follow for this portfolio was Joseph Carlson. He still owns it, but he said he agreed with Fundsmith, and he himself has been lowering his position in Apple. So I decided to just follow what Fundsmith did. I sold it completely. I did my usual thing. I looked at the top 10 list and I compared it to my top 10, and I just kind of made some corrections along the way as I redistributed the Apple proceeds. I kind of made some corrections. Here's his top 10. So yeah, I've still got Meta and Microsoft the wrong way around. So I did the same thing as last time. When I redistributed the Apple money, I didn't put any into Microsoft, and I allocated what Microsoft should have got from Apple, I put into Meta. So it's rebalanced a little bit. But as we can see, I've still got Microsoft as a top one. But this differential has been reduced a bit. Waters is now, so when I did it, I boosted Waters to above Fortinet, because that's how he has it in his list. There's Waters, and then Fortinet is lower down. It's not in his top 10, but it was in mine. So yeah, now, although, as we can see, since that happened, Fortinet has overtaken Waters, but when I made the change, Waters was just slightly above Fortinet. Yeah, so Marriott, as we can see, Marriott, I think I spelt it wrong there, didn't I? Yeah, it's Marriott, spelt it wrong. So that has made it into the top 10. But because I owned Booking, we can see here, because I owned Booking, which is in the same kind of industry, I made a note when that happened that my Marriott position is a reduced position because of the holding in Booking. So even though it's in the top 10, I didn't replicate that in my portfolio. I gave it a bit of a boost to make it close to Booking. So now it's a fair bit closer now than it was at 2.49% of the whole of the portfolio. But I didn't fully boost it to number 10 in the Fundsmith portfolio in the same industry. So that's why I have BKNG reduce in brackets there, because I reduced this holding because of my Booking holding. Same with Amadeus, that's in a similar industry. So yeah, they're the changes that I made when Fundsmith did its monthly update. And yeah, no other changes to the portfolio. I noticed this week that Assura, I think I saw it here, Assura is a British-based property business headquartered in Altrincham. I just thought I'd mention that because that is where I grew up. Anyway, just a little tidbit of information there. I'm wondering whether that's a sign that this is going to be the greatest investment of all time, because after I bought it, I realised its headquarters in my hometown. So we'll see. I haven't been there for about 30 years probably. No, that's an exaggeration. 20 years, 10 years at least. Oh yeah, so this week I got a Trading 2 virtual debit card. People on Reddit, I saw some posts saying the FX fee on that debit card has gone to zero. So I figured, I was already kind of half considering it. I think I was going to get the physical card when I next went to England. I was going to get that delivered to me sister's house. But since it went to zero, I thought I'd try out the whole paying for things with my phone thing. I've never taken the leap to try that before. I'll put the cursor there so you can't see the last number of my card number. But yeah, I've tried it. Here's my first 3 transactions, and I was a little bit worried that the cashback wasn't working. Maybe it's because I was thinking maybe because I'm abroad, I wasn't getting the cash back. But it takes about 2 days to get that cash back. That 2p that I've got there, that's only from the first transaction. So the 2 transactions from yesterday, probably tomorrow I'll get the cash back for those. But yeah, at the moment for this month it's 1.5% cash back on the purchases that aren't like rent or putting money into a brokerage account. There's exceptions that make sense. But yeah, so with the 1.5% cash back I'm getting till the end of December, it's a no-brainer to use this because I get 1% cash back on my Chase card. But the Chase card uses the MasterCard rate. Now the MasterCard rate is very secretive in what it's kind of based on. But what I think is, I have a theory that they charge somewhere between 0. Well, they'll never call it a charge, they'll just give you a different rate if you're going one way in the transaction and a different rate if you're going the other way. It's like a bid offer spread. It is a bid offer spread, and they take the cut in the middle, because I found this spreadsheet that I had. So this is an incomplete spreadsheet I had a while back, but when I lost my computer, I had more information in it. You see, I had it in different countries and I had more information, but I lost it when I destroyed my old laptop. It wasn't on the cloud. But yeah, so here's some information from when I was in Romania in 2023, and it was comparing the Revolut rate and the Chase rate, and we can see here, if we exclude the mistake I made on a Saturday there, where I got charged the Revolut fee because it was a Saturday rather than a weekday. If we exclude that, I found that the rate, this is me just comparing the rate I got with the rate that was shown on Yahoo Finance. So that Yahoo Finance rate was like, it didn't have any spread in it, you know, it was just like the middle rate. And I found that the Revolut rate was about 0.25% higher than the rate I found on Yahoo. And the MasterCard rate that Chase gave me was about 0.75% higher. So it seems to me that maybe there's like a 0.5%, 0.75, or I don't know, maybe the spread with Revolut is a 0.25 and the spread with MasterCard is 0.75. So, and it seems to me that the Trading 212 card is getting something similar to what Revolut gives you. They call it the interbank rate. So if there's a 0% fee and they give you 1.5% cash back, obviously that's way better than Chase at the moment. But that only lasts till December. In January, it will go down to a 0.5% cash back. Now, for these first few transactions I've done, it seems like the Trading 212 rate is about the same as the Revolut rate midweek. 0.25% is a good estimate, I reckon, compared to the rate I would see on Yahoo. So with that, at 0.5%, it becomes extremely close, because the difference is about 0.5%, but the cashback with Chase is 0.5% higher. So I think in January, if there's no change to the cashback rate that Trading 212 offer, it's going to be pretty much a toss-up between the two. So I'm not quite sure what I'll do in January, but at least for December, and just for the sake of experimenting with the phone really, I'm going to be using Trading 212 for my spending abroad. I mean, obviously, when I'm back in England, obviously the Chase card makes way more sense, because there is no exchange, there is no FX fee there. Sorry, there is no currency exchange going on. So the 1% cashback on Chase is obviously better when I'm back in England. Also, it's good if I ever want to take out more than £200 in a month whilst abroad. That is better than Revolut, because I think they allow you about 500 a month to be withdrawn abroad, whereas Revolut only offers you 200 a month before they start charging you a small fee. So if I can, the thing is, I don't think you can really use the phone at cash machines. I'll have a look, but I'm not sure that you can really. And a minor point is that the Chase current account doesn't pay any interest anymore, whereas the Trading 212 cash is getting 4.9%. So if I have to have a higher balance in the account where I spend from, it would be good if it was the Trading 212 one. It's a bit weird paying with the phone. I was a bit nervous the first time I did it, but it worked. My only issue with it is, although it shouldn't really be an issue, I feel like the security could be better. And I mean, mainly this is because the fingerprint scanner on my phone doesn't work anymore. So when I log onto my phone, I have to put I either have to point it at my face or put in a code or like a pattern on the phone. And when I put in the pattern, anyone could see me doing that. And what that gives people is, if they see me put my pattern in, all they have to do is grab my phone, run off. They could spend money on my card. And that worries me a little bit, because it's one thing being able to take your wallet, because my wallet is normally in my pocket, which is right at my chest. So I feel a bit more secure. Whereas my phone, I have out a lot more often because I'm normally navigating on a map or fast forwarding through a podcast. So I feel like I'm not 100% comfortable with the fact that my phone can now make payments. So I don't know. I'll see how I'll see how I feel. I think when I go home, I'll get the physical card delivered to my sisters, and then once I've got the physical card, I might delete the virtual card on my phone. I might get rid of that. Oh yeah, one thing I forgot to mention: when I bought Care REIT, I did it in my invest account, my general investment account. So this is not a tax wrapper. And I forgot to mention, I'm not exactly sure of the rules. I could look them up, I just haven't been bothered to. But I'm pretty sure that because it's outside of the ISA in Trading 212, I think when I get a dividend, they might be taking some tax off, maybe 20% tax. Now I'm pretty sure that all I have to do is just fill in a tax return, which I haven't done for quite a few years. Yeah, okay, and then the last thing, we had the annual report from Lowland. The NAV result was 16.3%, which is pretty good, and the share price performance was 18.3%. So they're beating the all share, which is pretty good. Obviously, they wouldn't have beaten the world index, but we never do with these English ones. So they've increased the dividend to 1.625, which is just a few percent increase. Yeah, so we can see there the last one of the year's gone up to 1.625. So for that financial year, it's gone up 2.8%, which is obviously probably going to be lagging inflation still. Yeah, so this is the paragraph where they kind of summarise why the revenue has gone down by 6.3%. So Lowland has chosen to prioritise longer-term gains in capital growth, which will eventually facilitate income growth in due course. And I think that's just to show that it's had a good effect on capital by saying the lower yielders have done well, so it's worth sacrificing current revenue. And then just as a side note, a couple of the major dividends have had later ex-dividend dates, which puts the dividend into the next accounting year. So that's just kind of a technicality, really. So you would hope that just because of those ex-dividends happening later is part of the reason why we've got dividend cover at less than 1 this year. This is why I like trust for income though, because even though there's a 6% reduction in the revenue the company got paid, we've still had an increase of 2.8% in the cash we've been given as shareholders, and that should hopefully continue next year. Anyway, so there's the update from Lowland. And we have a question in the comments, so let's address it, shall we? I don't know what I'm supposed to do with. I don't know what the protocol for this sort of thing is, so I excluded the username. I don't know. I don't know if that's a normal thing to do in this sort of scenario. I've got a question, not financial advice. No one ever come to me for financial advice. I'm starting to like your diversified approach. To be honest, that's the bit that made me add these cells to the spreadsheet, because that made me nervous if I start to hear people thinking that what I'm doing might be good. It made me worry, because I'm not so sure myself that it's good, but I enjoy it and I like it. So there we go. That's what prompted me to add the longer term return numbers into the spreadsheet. I saw some funds, some work and some didn't. I'm holding everything in the Vanguard Global All-Cap accumulation unit fund, and they're maybe getting concerned that relying on one fund might be risky, I guess is the implication there. Would you be nervous if everything you had was in that fund? I totally get the appeal of receiving the income from dividends, but besides that, what do you think? Basically, what would I say? Oh yeah, I wrote some notes when that comment was made. What did I write? I had a quick look on. Oh yeah, I had a look at my portfolio, and I estimate, because essentially this question is about risk, and I was thinking to myself, really, I don't think it's about how many funds you have. It's really about what you own. So if you just ignore the fact that I own about 30 different things and then a load of individual companies, it's what is actually in the portfolio underneath the fund. I estimated that my biggest holdings are Microsoft, NatWest and Barclays. I can't think of any other company that is so prevalent in my portfolio, because I own Barclays and NatWest individually, and then some of these other funds also hold them, some of the UK income ones. And the same, and with Microsoft, I know that it's the top holding in Fundsmith. I know that it's towards the top of Scottish American. I know that it's the top of Brunner. So I can't think of any other company that could possibly be my biggest holding overall. You know, I think look through is the term they use. And I had a quick estimate. I looked at all the fact sheets of the funds that own these companies, and I reckon my top holding is NatWest at approximately 1.9%, and then the other two are approximately 1.6% each. That is my biggest risk, is NatWest, as in terms of like one individual company making a mess. In those terms, we go to portfolio data for the All-Cap fund. This is what it is. It's the whole world. It's emerging markets, it's developed countries, it's smaller companies as well. It's everything. And if we go to that, I am, in terms of my largest holding, I am a fair bit lower than Apple at 3.73%. But I mean, it's not much, because you don't go far down the list before you're at 1.41%, which to me is a pretty small percentage. So in terms of any one company causing a riot in your portfolio, I'd say no, there's no harm in just holding 100% of your assets in this fund. That is presuming you are retired. You're not retired. If you're still in the accumulation phase, I would say 100% of this is fine. Maybe if you are like 5 years before retirement, add a bond fund. But yeah, I wouldn't worry about the risk here. And if you, I bet if you looked at the past performance of this fund, it's probably even better. It's probably even better than the life strategy here, which is completely destroying my own portfolio at 88% versus 31%. So in terms of past performance, obviously this wins by a mile. Because the thing is, with this approach of just owning everything, worst case scenario for you, owning everything in this fund, worst case scenario is that Apple goes to zero. Even if that, I mean, that's not going to happen, is it? But even if it got halved and it never really came back, or like, I think what companies, like Cisco Systems, I think was at the top at some point, and that's barely anything now. I think we have to go to like page, where's Cisco Systems? In the dot-com boom, Cisco Systems was up there. And look, it's now 0.25% of the portfolio. But the thing is, by owning this fund, when things get destroyed like Apple, if Apple was to get destroyed, other things take their place. It was only a few years ago when Nvidia wasn't even in the top 10, and it's now 3.53%. So to me, even though you do have higher percentages in individual companies at the top of the table here, I still think what the commenter there has is less risky than what I have. And I'm pretty sure about that. I would never advise like my mother to do what I do. It's weird. I know deep down I know what I am doing is more risky than this, but it's more fun. Because you've what do they call it? It's one of those phrases that gets thrown around all the time. What's it called? Oh, you own. Don't look for a needle in the haystack, own the whole haystack. That's what they say, don't they? That's something like that. So for me, if it wasn't just because I enjoy it and I'm a bit delusional about my portfolio eventually having a massive comeback, and I was still in the accumulation phase, it's still working, I would probably go for this fund on its own. Although, I don't know, maybe I'd go, because the smaller companies is such a small proportion of this fund, I think perhaps if I was sensible, I wasn't like doing this for enjoyment, I would probably go for something very similar, but where is it? VWRL, I think. Accumulation. Yeah, VWRP. I'd probably go for that, which is extremely similar if we go to portfolio data. But this is less diversified. There's no smaller companies in this. But the smaller companies are so much smaller by definition. It means that only the difference in the holding of Apple goes from 3.73 only up to 4.06. So there isn't much smaller companies in there. I'd probably go for something like this purely because you can own this much cheaper on platforms like Trading 212. Whereas to own this, which is a fund rather than an ETF, you have to have it on the more expensive platform. So like iWeb's probably the cheapest place to own it. You pay, but then you do pay a fiver each time you buy it or sell it. Or you have to go for the more expensive ones. Holding this in Hargreaves Lansdown would be really expensive if you had a decent amount of money in it. So for me, if I was sensible, not doing this for entertainment, I wasn't delusional, I would probably put all of my money into this one, which is very similar. But if this all-cap rather than just the all-world, if that existed in ETF form, I'd go for the ETF version of this, and I would put in the the smaller companies that this has. But given it's so close anyway, I'd probably go for this one. And then, I mean, it's not just about individual companies that might get knocked off their perch. It's also about a style of investing that could swing out of and back in favour. Like these are all like quality, reasonably high valued companies that are growing fast but have a high PE because of that. So that whole value comeback could happen, and that's partially what I like about my approach, is that value could make a comeback. So like in times like the dot-com bust in 1999, value obviously did very well because those investors kept away from all the things that were skyrocketing without any earnings. I mean, this is a different scenario. These things have high valuations, but they're a lot more real than anything was in 1999. These are actually making really good profits, and they're growing the profits, and they've got like stability of, well, there's like a perceived quality or like a surety about their prospects going forward. That's why they're the biggest companies, and that's why they have reasonably high valuations. But yeah, that is one of the reasons I go for a portfolio that has a lot more value in it. Like, I mean, just as a proxy for value, my 3-point-something% dividend yield compared to WRL's 1.52%, it's just kind of like a rough indicator of how much more value there is in my portfolio. Mind you, I don't think value is the right word though, because everyone wants value. It's value in terms of current earnings and the price of the share. Because you could say value is getting something that's low price compared to its future earnings in 10 years' time, which is what these sorts of companies are. The ones that are at the top of this global all-cap fund, these are value in terms of their prospects for like in 10 years' time compared to the price of the share now. Whereas a lot of the things in my portfolio are priced low compared to their current earnings in terms of like a percentage or a ratio. But who's to know what will carry on doing well? At the moment, things with prospects for the future, well, they have current prospects, but they're valued highly for their current earnings. But because their earnings are growing well and they're growing with surety, they have a higher PE value. But that could carry on going forever. But again, that is one of the reasons why I invest like I do. I don't have much bonds. There's tiny amounts of bonds in my portfolio. But so the way I see it is, when you retire, you have a bond allocation to reduce the volatility of your portfolio, so that when you're withdrawing from it, bad times don't completely ravish your portfolio, because hopefully it doesn't go down as much. But to me, I've kind of done that in a different way by having value things that I kind of end up having high dividends. but I'm not so sure that it actually reduces the volatility, to be honest, looking at what's happened recently. But what I'm thinking is, if there is like a whole like 10-year period, like from 2000 to God knows, I don't know when it stopped, but there has been long periods of time where value has outperformed growth. And in that situation, this fund, having most of its top holdings in more growthy quality companies, will probably underperform something like my portfolio, I would hope anyway. But yeah, I mean, to me, I mean, this is the same as the point I made earlier. If that does happen for 10 years, other things you still own the value companies. You still own what's obviously a value company. JP Morgan is more value. It's not like a mega deep value like some of the UK stuff. ExxonMobil, that's probably a value company. Berkshire Hathaway, not really sure, but I don't think things are overpriced in there. Is there any like Procter and Gamble? I don't think that's really a high PE. But yeah, everything that I own exists in this fund, so it's not going to do the worst. But there is scope there for it to have a period of time where it underperforms something like a value portfolio. But it's just I think you're still better off just letting it happen, and this portfolio will adjust itself as different things do well at different moments in time. It will never stray too far away from whatever ends up working for the next 10 years, because it owns everything. So yeah, it's all crystal ball gazing and doing what makes you feel comfortable, I think. And I've got a portfolio that makes me feel comfortable, but intellectually I'm not so sure that it's the right portfolio. And then as you get close to retirement, you follow what I mentioned in this video a while back.
Hi there, just read this.
That video talks through the strategy that I would do if I was more sensible about just having a like 25% of unit of it in a bond fund, the rest in a global tracker, and then rebalancing each year. But yeah, that video also illustrates how much better off I would be if I had gone for this more standard approach. I probably wouldn't feel comfortable owning. I see a lot of people on Reddit are like 100% in S&P 500, and they're not even American. I wouldn't be comfortable in just an S&P 500 tracker, but a global one like this, which if America does carry on doing well, you get a higher and higher percentage in America, so you carry on doing well as well. But then if America has like a 10-year period where it does terribly compared to the rest of the world, it doesn't matter. You've still got that 35% it is now. It's getting lower and lower. Like 35%, I think, that's not in America. So 63%, 63.4 in the United States on this section. Yeah, so you've got everything there. Like apparently Japan was like a massive portion at one point. Japan was. So if what happened to Japan happens to the United States, whatever replaces it, you've got in your portfolio. It's the questioner here may think that I'm more diversified, but actually I'm not so sure. I think the questioner is more diversified than I am, really, by owning the whole haystack. It's me that's the higher risk here, to be honest, and it has shown in the numbers. Yeah, okay, I think that does it. All right, I think that's it for this week then. Thanks for tuning in. I'll see you next time. Bye.